Good afternoon, ladies and gentlemen, and welcome to the Glantus Holdings PLC investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted anytime via the Q&A tab situated in the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. And these will be available via your Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Maurice Healy, Founder and CEO, Grania McKeown, CFO, and Jeff Keating, CTO. Good afternoon.
Good afternoon. Good afternoon, everybody. Thank you for taking the time to join us this afternoon and to learn a little bit more about Glantus as I get used to this technology. I'm Maurice Healy. I'm the founder and CEO of Glantus. I've been in technology since Moses was a boy, I like to say. So I've been in technology a long time. I have twice taken companies previously to AIM, ITG Group in 97 and Calyx in 2005. And we exited the markets in both cases, making a lot of money for our investors. I'm joined on the call by Grania McKeown, our Chief Financial Officer, and Jeff Keating, our Chief Technology Officer. And as we go through the presentation, they will introduce themselves as we go along. So we're starting this presentation in an unusual way, and that normally we start a presentation like this, you probably give a bit of the history of the company, and we will do that. But it's important to begin with that we can explain to everybody our market and the market that we operate in. So we're in accounts payable for large organizations, and we start here because often people kind of think of accounts payable as a dusty finance office and somebody in the corner writing checks. Our market is with these large global organizations, and their spend is north of $1 billion in the US and north of £500 million sterling in the UK. They have suppliers anywhere from 4,000 to 120,000. So it's a big market, and it's a big area within these organizations. And people often ask us, do we do accounts receivable? And yes, our platform can handle accounts receivable as accounts payable, but we have directed all of our marketing and all of our lead generation towards accounts payable because that's where the biggest need is, and that's where we can get the most traction quickly. Every year, these organizations, they leak millions in credit notes not being processed, duplicate payments, contracts not being complied with. And we came up with a solution for that. It says you're getting used to the technology. So the reason that they're having these problems, you must think of these global organizations, as I said, which is why we start here. They've got multiple regions, multiple divisions within those regions, multiple ERP systems, or even if they have just put in a full-blown ERP system across their organization, they're still going to have multiple instances of that. And no matter how they go about this, the data is still siloed, and the management of their suppliers is still split around the place. So you're getting multiple instances of each supplier depending on the region. And that leads to problems when it comes to the payments, and that's why they leak so much. And our solution, keep hitting the wrong button, our solution is a very elegant solution for them. So we have developed our Glantus data platform. We sit in the cloud above the organization, and we bring the data from all of the instances, all of the company, all of the geographies, and we put it together in one place and make it manageable. And we begin them on a journey by, first of all, recovering what they've already lost in as I said, in duplicate payments, in credit notes not processed, contract compliance, whatever it might be. We start with that. Then we put in our automation to prevent these things from happening. And again, our product, it's in the cloud and it's a real-time product. So they're in control of that situation for the first time ever, these large organizations. So we put in the automation, and as long as they keep using our technology, then we stop that problem from reoccurring. And then we have the advanced analytics. And again, it might seem strange with these large organizations with their super technology that these analytics are so, you'd imagine it would be straightforward enough, but it's not, because as I've explained, the data is siloed around the place. So for instance, we spoke to one client and we asked two questions. What's your spend? How many suppliers do you have? And one global organization said, I'm sorry, I'm embarrassed to tell you, it's somewhere between 80,000 and 120,000, but we don't know. So we solve that problem. We bring the data together. They can see all of the instances of it, of their suppliers. So by doing what we do, we first of all recover lost working capital. So there's an instant return on investment. We then put the automation in to prevent it from happening. And then we have the advanced analytics, which gives them a good overview of their supplier ecosystem and allows them to work it more efficiently, more effectively, more cost effectively. So that's the space we work in. We started in 2014. Post the IPO, it's still 55% management owned. And as I talk later, that's we have a clear vision of how we're growing this value. To the end of 2020, we turned our recognized revenue was 8.5 million euro. We've done 3 small acquisitions, and acquisitions is a part of our story as we go forward. We have 85 people in the group. It says 88 staff there, 88 staff in the group. And we only sell our own product, and it's all our own IP. On the call, as I said, you've got 3 of us. The executive management team, we've got a Chief Operating Officer, Andrea Wilkinson. She operates out of the States, out of San Jose. And Paula Nolan, our Chief Compliance Officer. Compliance is a big issue for us. It's an important area, given that we're dealing with these large organizations. But not to mislead you on this, as the executive team, we have a head of the States, we have a head of EMEA, and we have a head of partnerships, and good solid infrastructure beneath each of those. And it's important because with our growth plans, it is important that we have a structure, and we put a structure in place that can facilitate that growth. So that's the executive team, but it's a very strong management team beneath that as well. We have 50 large enterprises, 250 corporate SME, of which 50 are of real interest to us. And we analyze about over 100 billion of our customers spend every year. We operate in Dublin is the head office, and there are reasons for that, which Gronya will go into later on. But the operations for EMEA are run out of Greater London. Our marketing people thought Greater London sounds better than Harpenden, so it's out of Harpenden that we do that. The States is run out of San Jose, and our development teams operate out of Poland. But our customers are in multiple regions. So when you look at how we interact with our customers and with the various divisions, you see that we're providing services across 50 countries, over 50 countries. So I mentioned that we have a Chief Compliance Officer, and it is really important. We've got 3 standards, but the one I just draw your attention to is 27701. It's the most recent. We're one of the very few fintech companies to have this. It's a new standard. It's all around privacy of information, protecting data, and it's a really important one for our customers. Because we have this standard, it removes about 33% of any queries or RFPs that we're responding to just by having these standards. And secondly, because we have those standards, where large organizations are comfortable allowing us to access directly into their systems. So we write to their systems and we extract data from their systems. So we pay a lot of attention. We run the business by these standards, but they are very important to us. A bit about our market. The AP market is growing all the time, especially our market with these large organizations. And this market grows as economies grow. As these companies grow, the problems that we solve becomes bigger within them. And it's also fueled by M&A activity. So if one of our customers is acquired or acquires or is involved in a merger, then the issues I pointed out earlier on of multiple systems, geographies, instances, that's compounded by M&A activity. So we become even more important to these organizations, and they have to implement our solution across an expanded organization. So the more the economy grows, the more M&A activity is, the better for us. And as I said, it's a sticky solution because once they're using it, everything is fine. If they stop using it, all the problems they had, they start to return. So we become an important factor within all of that. People often ask us about competitors. And it's an interesting question. We've now, we're on one of the magic quadrants of GEEP2, and they've split our market down into these three areas: the discovery and recovery, the intelligent automation, and the advanced analytics. And those are our competitors. We don't have anybody that does it the way we do it. And that gives the, effectively we digitize the AP function without them having to change anything. So our solution is all around sitting above their system, so they don't change their systems. They don't have to retrain their staff. They don't have to use expensive internal resources. They don't risk operations. So it sits above the entire AP function. And when we're in competition with these companies, so if you take Technology Insight there in the analytics piece. If we're up against Technology Insights, yes, they've got a good solution, and we'll show our analytics, and they'll show their analytics. And Jeff won't be thrilled with me saying that. To me, these days, one dashboard looks like any other. But the fact is that the context in which we present, so we bring them through the Glantus portal into the platform. And they can see the journey that we can take them on. They recognize the problems we're solving because every single one of these organizations has the problem, and they see how elegant that solution is for them. So we tend to win against the competition on the basis of the context that we have developed our platform and the journey that we can take them on, because whatever they come out looking for, we can solve a much bigger problem for them. Okay. Why is that doing this? Hold on. Get rid of that. There we go. Okay, to give you an overview of where all this came from and how we go about it, Jeff will take you through the platform.
Thanks, Morris. So similar to Morris, I've been involved in IT for quite a number of years, and my role as Chief Technology Officer within Atlantis allows me to drive the product development or product roadmap for quite an exciting platform, as we call it, the Atlantis Data Platform. So when we set about developing this initially, it was to sort common data problems we noticed most organizations were having, predominantly around data connectivity. So the ability to connect or process data they had within their different systems. And again, as we described, most of the clients we deal with would have data in more than one location, be it an ERP system or finance system, warehousing, banking, and so on. So we provide the mechanisms to connect to that data, be it in database or file-based or API type connectivity, even social media and event stores if necessary. So once we can gather all that data together, it allows us to transform it and enrich it to allow us to do something else with it, to drive some other function within the business. So one of the key functions we drive it at is automation. And a lot of that automation is driven these days by document automation as well. So it could be file-based information from suppliers, particularly around invoices, purchase orders, requisition statements, and so on. So doing something with that data, but driving an action of some sort based on anything that's happening with a source or application. We can drive an event of some sort from that. So the automation is a key part of it. Despite what Maura says, our visualization is stunning. And so we provide dashboards, we provide reports, we provide pivot tools, again, giving our end users really simple access to the data that's been generated. And again, the key part of that is it's not a point solution or a single point solution. It's data coming from multiple different locations, multiple different sources. And then we apply data science on top of that. So the data science piece allows us to drive the likes of, again, language you'll hear us using a lot will be anomaly detection. So looking for mistakes, looking for faults, looking for something that's going wrong predominantly. So that kind of core capability as it is can really be applied to any sort of data. But what we've done through the platform or through the Glantus offering is targeted that specifically at the AP function. And within that, there's very similar slide to one Maura said earlier on. We concentrate on 3 silos within that, is discovery, automation, and analytics. And within those, there's a number of functions each for different use cases, slightly different customer use cases, even different types of enterprise. So within the discovery space, there are 3 functions. The first one is AP anomaly detection, as I mentioned earlier on. So really, that's our ability to get into the data, get into the AP data to find problems, to find errors in payments, to find duplicate invoices, mispostings, and so on. So that's using the anomaly detection, it's using the data science to extract those type of mistakes or find those mistakes in client ledgers. In a similar way, then we do what's called vendor credit recovery, which is really it's finding missing credits based on historical statements from suppliers. So where the vendors or suppliers haven't, their statements haven't been reconciled on an ongoing basis, we can highlight where mistakes have been made, predominantly where credits have been missed, so credit notes haven't been processed. And third piece then is contract compliance. So that's really monitoring contracts, long-term agreements over a time span. And again, looking for inaccuracies, looking for mistakes, checking invoices against agreements and so on. So what all 3 of those functions have in common, as we call them discovery, is they lead to a recovery of some sort. So we're generating working capital for our clients in that area because we're recovering lost funds for them. So the discovery can, but doesn't have to, lead directly into automation. The automation itself can stand alone. And in that, there are 3 areas. So invoice processing would be, again, using our smart OCR technology effectively to remove the manual effort involved in capturing or matching invoices, incoming invoices, predominantly these days coming through PDF or Excel files through email. We're extracting those details directly from the emails to process them, to manage them, and to move them on into the ERP system. Again, we're greatly reducing the cost involved in processing them, but also we're reducing the amount of errors as well. The human element of it is largely removed. Statement reconciliation, the second piece of the automation, sounds quite similar to the vendor credit recovery, but it's done on more of a real-time basis. So this is where we're reconciling incoming statements directly against the ledger, the AP ledger, and again, just highlighting both missing transactions both way or errors. So something that may be in the ledger, not in the statement, and vice versa, or it could be a currency mismatch or a date wrong or a value wrong, and so on. So again, helping to speed up the efficiency around month-end reconciliation and get the AP department humming in that regard. The final piece of the automation then is master data optimization. So again, as Maura's alluded to earlier on, the larger the clients tend to be, the larger this problem is. So the lack of control over the management of master data, I'd say master data, predominantly supplier information in itself, particularly where there's multiple regions and multiple ERP systems or multiple divisions involved, which again can lead to some of the type of errors that are found through the discovery process as well. So, duplicate invoices, duplicate payments caused because of effectively duplicate master data as well. And finally, then on the right-hand side, we have the AP analytics, again, broken down to 3 very specific areas within that for the AP department. So spend analytics really is monitoring spend across all the various locations, divisions, systems used for forecasting, decision-making, and so on. And that can be by category, by department, and again, all trended over time as well. Performance then really is giving both an internal and external view of the AP process. So whether that's looking at individual suppliers and vendors, or groups of vendors across various categories, looking at historical patterns, but also just measuring the internal processes within the department. How are transactions being processed? How long is it taking? Is proper compliance been adhered to, and so on. And again, that's all underpinned by the predictive element as well, which we can use for for risk and for fraud, even cash requirements, and all trended over time. So that they all form the basis of what we where we focus our capability, our platform capability within the AP department. So again, as a quick illustration of that, then we have an example client here, which is a recent win. It's a UK-based multinational in the service industry. And again, it's a very typical enterprise client from our perspective. They've turnover north of 10 billion euro. But again, they suffer from a specific challenge around multiple entities, multiple divisions, locations, and so on. And the little graphic there in the center actually illustrates that that's really a matrix of the divisions they have across the different entities and all the various ERP systems in use at a single point in time, which is, you can imagine, can be from a management point of view a bit of a nightmare. So what we've been able to do is layer our applications on top of that, our platform on top of that, giving the connectivity over all of those systems in a single location in the cloud. That it helps us to effectively to manage, to monitor the supplier information, and for the first time they've been able to perform a discovery process across that ledger, and again, yielding results very, very quickly. We are consolidating all the master data into a single location, which allows for management, and but it's also giving great visibility and helping them to drive some other initiatives as well, or particularly around the likes of expense payments, lower level payments as well. And the key thing, again, differentiator, back to the competition chart we were looking earlier on, is that what we're providing there is a number of solutions, but they're getting all of that from a single supplier, which again is a huge advantage. Okay, Morris, back to
you. Thanks, Jeff. I'll get back here. Yeah, so we've the important thing around this slide, they're great names and big names, but they're in multiple sectors. We are not sector specific. We just, as I said earlier, ask the two questions: how much do you spend and how many suppliers do you have? But these are all existing customers, and there are a few there I wouldn't have heard of before we entered the States, people like Granger. There are just so many of these large organizations around at the moment, and or issue, and I suppose if I just move this on to talk a little bit about the areas of growth. This is the part I like talking about. So where we are with all of this. First of all, why did we raise money now, and why did we choose an IPO? So the reason we decided to raise money right now was because we need to invest in the organic growth of the business. We've got these 50 existing customers, and we're cherry picking at the moment. We're dealing with about 10 of them seriously, and we're keeping the others going. We need to invest in sales and account management and build that up, and a little bit in marketing as well. So with the existing customers, we need to spend, and then because we've established the brand, over the last 12 months, COVID and pandemic, we've been doing a lot digitally, a lot of events, both in EMEA and the States, and a lot of digital campaigns. And the product and the brand has taken hold within our sector. It was always going to happen in EMEA, I think, but in the States, we've been surprised ourselves at how much. And our pipeline, has increased dramatically since the start of the year. We're getting a lot more inbound inquiries now from these large organizations, which is great, but it meant that we need to invest in the organic development of the business. And the other area we need to invest in is the partnerships, but I'll come to that in a moment. So that's why we're raising money right now. The second, the reason we chose to do an IPO is because the PLC badge means something with these large organizations. we're not just a small company anymore. We're a publicly quoted company, so that gives us a strength within these organizations, and it means something. And the London Stock Exchange, having that's a brand in itself. So again, particularly in the States, being a PLC on the London Stock Exchange is a big deal with a lot of these customers. So that's the reason for it, and we have a lot to do on the organic, but the growth both with the existing customers and the inbound now is substantial. And then I mentioned that we also have to invest in partnerships. Now 18 months ago, if you had asked me about partnerships, I'd have been a bit cynical. I don't want to be one widget of 12 widgets that some company is selling, but we've actually narrowed in on what type of partners we want, and what partnerships will work for us. So we have criteria around, first of all, the partners have to be dealing with our profile of customers, so large organizations and the finance function within those large organizations. And secondly, they've got to be what has worked for us is when they're providing niche service in there. So we've got one organization that we signed up before Christmas, URA, and they're out of Michigan, and they've got the same customer profile, but they only provide services around the utilities within those large organizations. So they needed to expand that. They needed to expand the offering for their own growth, but they also needed, because the customers were demanding more from them. So we partnered up with them. We are now an integral part of their strategic growth, and that's where we want to be with a partnership, that we're not just an add-on. And that we signed that up before Christmas, and we've already signed 2 of their customers up, and that will progress. We're also dealing with a company, and their focus, again, they're bigger than URA. They're a Canadian company, or they work in Canada and the States. Their focus, again, same profile of organizations, but they only deal with tax and tax recovery within those organizations. Again, they need to expand their offering. We're the perfect partner. They're the perfect partner for us, and we're working on some big clients with them at the moment. And then finally, there are also organizations, with an organization we signed up recently where it's more an OEM solution. They're taking our product and integrating it into theirs. It's a large organization, and they will be rolling it out to their base. And their base, they work with mid-market accountancy firms, provide software in there, and they grew by acquisition, multiple types. Same problem that an AP function has. They can't give their clients one view of everything. They can't standardize the output from the account system, and they can't do compare and contrast. So we're going to be embedded into their software, and they'll be rolling that out. So we have a lot of excitement around the partnerships, because we've found the way to do it. And the other thing is, as we're expanding, and I'll talk about acquisitions in a moment, as we expand, we don't do greenfield. We don't do greenfield operations. You won't hear of us going into a new region, opening an office, hiring a load of staff, and hoping for the best. And with where we are with acquisitions at the moment, we have a pipeline that covers EMEA and the States, and that'll keep us busy for a while. So the partnerships is a good way to go into new geographies. It doesn't cost us much, and if we get the right partnership. So we partnered with Enterprise Ireland. I'm one of their people, and they're doing the pipeline, and our head of partnerships, Andrew, is working through that. So we expect to grow not only through the partnerships, but geographically as well. And then finally, acquisitions. We have a skill set around acquisitions. We've done 3 small ones, the most significant being JPD. We're very clear on why we're doing acquisitions. first of all, we're clear on the criteria we're looking at. We're looking at generally, again, they're working in our space. They have our profile of customers, so we want a good spread of customers. We want a good level of recurring revenue. Sometimes their technology might be interesting, but it's generally not the technology per se. It's the know-how. Once we get the know-how, then we drive everything from our own platform. So good, strong recurring revenues. And the big reason around this for our scale is important in our industry. And we're able to acquire these companies often because they're subscale, and post synergies, we're going to get them, between 4 and 6 times Ebitda. Grania will go through the numbers of JPD with you shortly, and you'll see what I mean. And because we can grow the Ebitda very quickly. We are very good at finding the acquisitions, negotiating them, and integrating them. And once we can buy them and keep within those metrics, then we know that when we reach scale, particularly in the US market, our multiples are going to be 18 to 30 times Ebitda, or 4 to 5 times revenue. And we have a line of sight to that. So we've got really good, strong organic growth ahead of us. We've got a partnership program that we think will be driving a lot of revenue for us. And then the acquisitions will drive us forward. So we're very ambitious, even in this year. Nobody should invest in our company if they don't want action, because we are going to be a very busy company, because all the 3 of those areas are live, and clear pipelines across all of them. So we're going to be exceptionally busy, and the drive is to get this over the next couple of years. Management's ambition, I think it's worth noting that, again, that management own 55%. So we're in this to make as much money for ourselves as we are for our investors. And our drive across those 3 areas is to try and get her up to around $50 million revenue over the next couple of years. And we believe we can do that. We believe there's a pipeline across the 3 areas to get us there. And that's our ambition, and that's what we're going to be pushing for. I'm going to hand over to Grania. You're on mute, Grania.
Damn it. Sorry. Promised myself I wouldn't do that. Thank you, Maurice. Grania McKeown, Chief Financial Officer. I've been with Glantus since 2017. I've been in finance for over 25 years, and my background is multinational as well as SME, and all within the tech and telecom sector. So just a few slides on financials. Obviously, the research note has been published, and the admission document, which would obviously contain much more more detailed level of financials. So this is just a few slides to put into context the previous slides that Maurice and Jeff have presented. The left-hand side shows our growth over the last 3 years at a revenue and Ebitda line. As you can see, year-on-year growth, and most importantly, our recurring revenue is growing year-on-year as a percentage of total revenue. This is obviously a key area of focus for us. The right-hand side is just laying out on a pro forma basis the historic results of the companies that we have acquired, as well as obviously our growth over the last 3 years. So the purpose of this is, and we often get asked about organic growth versus acquisitive growth, and the purpose of this is to demonstrate, I suppose, our skill set in finding companies that have huge value, but it's to unlock that value. We're very good at finding companies that we can see where there's value, unlocking it, integrating it, and driving that through. As Maurice said, we're buying 4 to 5 times post-acquisitive Ebitda, but generally at acquisition it would be 0, and then we drive and unlock that value. Sorry, apologies. This slide here then just breaks the revenue down in a bit more detail, just to put some context into how we bill our clients and our revenue streams. As I said, a huge portion of our revenue is recurring. Our subscription revenue grew year on year, even in a COVID year, which was obviously tough for everybody. Our subscriptions grew by 10% last year. And then the transactional revenue, this represents the recovery services that Jeff was explaining earlier. So recovery services being finding those missed credit notes, finding the duplicate payments, and recovering that revenue and working capital on behalf of the customers. That traditional revenue stream comes by transactional recurring revenue. Professional services then is just a byproduct of our subscription revenue. It's linked to it. We generally will charge an upfront installation kind of mapping fee for the customer to get them on board with the software. So year on year, very strong growth. 2020, obviously a soft year for everybody, but we still managed to grow our revenue organically and then obviously by acquisition. This slide here breaks down the Ebitda, and just to reinforce what I was saying earlier, that our Ebitda is all organic. When we acquired JPD in January 2020, it was 0% margin, and we knew that we could unlock a huge value in that. One of the reasons why it was such a great acquisition for us was they had no technology, very labor-intensive processes that really needed to be evolved. Jeff and his team quickly set about transforming the company and rolling out the Glantus platform. So the very products that we sell to our customers, we deployed that internally within JPD. And within the year, we'd realized over $1 million of cost savings, 1.5 million annualized going forward, as well as some tech savings as well, because obviously we replaced it with our own in-house. We continue to invest in our R&D year on year. Our 2021 budget is about €1 million, and that was always going to be investing in our existing product and future roadmap. This slide here is just breaking down the numbers in a bit more detail down to net profit line and our KPIs. Our key KPIs would be our recurring revenue, as I explained. That revenue stream is in the form of our subscription and transactional revenue. And our headcount, again, just as I said earlier about realizing massive cost savings on those acquisitions that we've done and driving our revenue per head higher and higher each year. And going forward with all the technology we've deployed internally, it means we've got huge capacity to take on new business with the existing headcount. As Mara said earlier, we are headquartered in Dublin. That is of huge advantage to us. We enjoy, sometimes controversially to our European partners, we enjoy a very low corporation tax rate, but clearly to the benefit of the company and its shareholders. The corporation tax rate in Ireland is 12.5%. And most importantly, the IP is all based in Dublin. So this means that any software sales made throughout any of the businesses in the US or the UK, that revenue ultimately profit comes back to Ireland at the Irish corporation tax rate. And back to you, Morris. Thank you very much.
Okay, and yeah, so that slide is the summary slide, and it tells you that we have about 1 million years of experience on the management team, most of which are probably my years. But actually, I think I just want to give you 3 reasons why anyone should invest in Glantus. The first is that we now have a proven technology. The technology has gone through some testing. That organization I was talking about, who are embedding our software in there into their product, did some due diligence on it. And it's a proven technology. It's a proven market. We know the need is there. We're handling the inbound calls. We're handling the calls from our existing customers. So we know we've come up with something that works. So proven technology and proven market. The second reason is that our revenue type, we have 89% recurring revenue. It's very sticky. As I said, you stop using our technology, your problems come back. So you need to keep, you have to keep going with us once we're in there. So very sticky. And the third reason is that all our investors are aligned with management. with one ambition, and that is to make a lot of money out of this. And we know how to do it. We know what the arbitrage is and where we are at the moment on our multiples, where we'll be acquiring companies, and the multiples at which we'll exit, whatever form exit might be. But the valuations that will grow as our revenues grow, we know how those multiples work. And so we know that we're going to drive a lot of value through this business over the next couple of years. So they're the three reasons I would invest in us. And I'm quite happy now to hand over for questions. And thank you for your time and attention.
Maurice, thank you very much indeed for your presentation. Thank you very much indeed to Grania and also Jeff. Ladies and gentlemen, please continue to submit your questions using the Q&A tab situated on the right-hand corner of the screen. Just while the company take a few moments to review those investor questions submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order the company can better understand your views and expectations. Guys, perhaps before we go into some of the questions through the meeting, we had a number of pre-submitted questions from investors, and perhaps I can start off the Q&A session with these. The first one reads, what historically have been the organic growth rates, and how do you expect that to change in the future?
I'll take that one. So our organic growth rate has historically been in excess of 20% year on year. And then, as I explained at the top line, that it would be 20% year on year. But from an Ebitda perspective, the organic growth would be much higher, because that's where we really find that we've got a very core skill at driving value out of those acquisitions. We expect going forward for our organic growth to be in excess of this, as the purpose of the IPO funding was obviously to invest internally, and that deployment of that investment should yield even higher results.
Fantastic, thank you. And Boris, you did touch on one of these areas here about competition, but can you provide more detail on how you fit in the competitive AP automation landscape against the likes of Stamply and Kisflow?
When people come up with competition to us, that's why that competition slide, I broke it down into three areas, because we tend not to have come up against anyone offering the holistic solution. So we break it down into those in each of those areas. But as I said, we tend to win generally on the context of being able to provide a more holistic solution. As for the individual companies you mentioned there, Jeff, you're more familiar with them?
Yeah, two very good solutions. I think Stamply would be very strong in the kind of the purchase to payment side, but very specifically in the US, and even more specifically in the kind of the mid-market or even smaller end of the end of the spectrum, so not necessarily enterprise level where we're dealing. Kisflow then would be very good workflow automation tool, but very general purpose. Whereas again, we would see our workflow would be very specifically targeted at the AP specifically, whereas Kisflow can effectively be used for across an organization, probably again at a smaller level, but for multiple different reasons. It wouldn't have the specific focus we do on the AP side of things.
That's great, thank you. Next one we've got here reads as follows: how big is your sales and marketing team currently? What are your plans for developing in this area, and what is your strategy for attracting larger enterprise customers?
Yeah, so I guess this is one of the reasons why we have why we raise money. We've gotten as far as we have with quite small teams. The pure sales in the US and EMEA, we've only had 3 in each area, and we intend at least doubling from a pure sales point of view, and then with an additional 4 or 5 account managers on top of the sales side of things. So there's a requirement for around about 10 more people to come in over the next 12 months, just to service the existing customer base, and also with the inbound inquiries at the moment. Our sales and marketing strategy, we have we do multiple ways. One is events. It's been online events up to now. during COVID. So that's been very successful for us. We, if nothing else, we stand out because of our color scheme. Our competitors tend to be in purples and blues in the tech space, so the orange stands out. But I think it's been one of the reasons we've established the brand so well, particularly in the States, has been these events, because when we get the chance to show what we can do, then we always get inquiries. We then do a lot of digital campaigns. We will go after, even though I said we're not sector specific, when we have success in a particular sector, we will go after that sector anyway, just because we know what their immediate needs are. So we will go and do campaigns around specific sectors. One of the more recent ones that we've taken on has been in health in the US. It turns out that hospital groups spend tens of billions every year and have anything up to 100,000 suppliers, and they're a market that is really important to us. So we will focus on something like that with a partner that's bringing us in there. So these kind of areas, we go forward with it, and then we do a lot on LinkedIn, but it's predominantly digital at the moment.
Fantastic. The penultimate pre-submitted question we've got here is, what is the rate of churn for customers in your large enterprise and SME segments, and how do you track this?
I'll take that one. So we've actually lost no enterprise customers. Again, echoing back to what Jeff was saying, is that, we find once these customers adopt our solutions, what we're offering is just something they just want to keep getting more of. The SME sector, our churn rate is 4.5%, and that's on a value base as opposed to quantity base. And we track that on a 12-month rolling average. So we're continuously, it's a live database that we continuously track on a rolling basis.
Fantastic, thanks, Grania. The final one we've got here: when will Arden be publishing their initial research note and model? What sort of guidance are you providing for the current year and into next?
Okay, I'll take that. The research note is out. It's on the Arden portal, and it's also on the. There's a link to it on our investor website. So that includes all their the analyst forecast of our 2021 and 2022 forecasts.
That's fantastic. Thank you indeed. That concludes the pre-submitted questions. If I could perhaps just ask you now to click on that Q&A tab, and you'll just see some of the questions that have come through from investors. If I could just ask you to read out those questions where it's appropriate to do so and give your answers, that'd be fantastic. Thank you. Yeah,
I see there's a few there from a financial perspective, so I'll take the jump and let Morris and Jeff have a read of the others. So the first one there from a financial, when do you forecast your first pre-tax profit? Obviously, we'll be releasing our H1 results before the end of Q3, before 30th of September. Our year end is 31st of December for all our entities. So we'll be releasing H1 by the end of September. And then probably in Q4, we'll be given a guidance on 2021 for those results. Next question there is, how long will the current funds last? How quickly will we burn through it is the question, I suppose. And how will acquisitions be funded? So the current funds, we IPO'd for two reasons. One was, to invest in our organic growth, and also to really expand our partnership links and our acquisitions. The organic, the funds that are split between organic investment, we have sight of investment in that over the next 24 months at least. And as Mara said, that's primarily investment in a bit more development, and also most importantly our sales and marketing area to service the existing customers. Our acquisitions will be funded depending on each acquisition, either by debt and or cash or equity. And each one will be assessed on its own merit as it comes up on how it fits into our debt Ebitda profile. We're going to be very responsible when it comes to that. The first thing we are going to do, and actually this leads into another question here about the BPC loan agreement, is the first thing that I'll be doing is refinancing the existing debt. So it can be deemed to be a bit on the expensive side. Obviously, post-IPO, we're in a much stronger position, and we want to make sure that we've line of sight of enough funding, a funding line that will keep us going for the next few years, so that we've got a good relationship with a funding partner for that, but at more attractive terms. So I think
if I just add into that, we're not and haven't been traditionally a high burn rate. You know, we're going to be judged on our revenues and our Ebitda. Yes, we're going to be investing in the short term in these areas, but it's not kind of, you know, that we're just it's not a high burn rate business. So we don't do that. And as Gráinne is saying there, our intention is to always have a mix of the debt and the equity, but we won't go more than 2 times Ebitda on the debt. So we're conservative enough from that point of view. And then on that, I'll just take a couple of these for a moment. I know IAG is a customer, and airlines have been significant AP numbers. Yeah, that we've had those customers. We've had they've had to handle the last 12 months in different ways, and they're all back with us now in discussions for the next phase. So it's an area that we will continue to be a part of, a sector we'll continue to be a part of, and that we have a solution for. So yeah, of course we'll be focusing on that. Seems to be a drop from the listing price. What is the reason for this? It was subject to debate. So on the day, it was a pretty bad day for the markets when we went on. My understanding, and I guess it's Arden can answer this a little bit better than me, that there was somebody selling, but I think all of that has been taken care of. I believe that it's at least back to where it should be, and hopefully it'll progress from there. But I can assure you that it had nothing to do with anything going on in the company. It was more things going on outside the company. We're very comfortable in our position within the company. I'm trying to see the next one. I think is back to you, Gráinne, the forecast for 21.
Yeah. So as I said,
Alex's forecast, just to be clear.
From the analyst forecast, yeah. So I think that I answered that one as well.
Okay.
And then the final question, Maurice, if you'd like to take that, what's the sales process and pipeline, and how can you accelerate it even further?
Yeah, in one sense, and I say this against ourselves, we were taken a little bit by surprise by the reaction to the product, particularly in the States. So we're playing a bit of catch up at the moment, and so the new hires are going to be coming on over the next few months. The pipeline since the start of the year has pretty much doubled on the organic front. We've always had an acquisition pipeline, so we will continue to monitor that and work across that. And then the partnerships, again, that pipeline has gotten really strong over the last while as we've narrowed into what we want to do. From the point of view of the process, I think it's probably worth answering that in a little bit of a broader sense. From an initial meeting with one of these large organizations, it takes about 6 months to get to a purchase order. And then depending on the nature of the installation, it can, if they want to start with a module quickly, we can have them up and running in 4 or 5 weeks. If they want to go live with everything at the same time, it might be more like 10 to 12 weeks, and then it's about another 6 weeks until we get revenue. So the entire cycle is 6 months to PO and another 3 or 4 months to getting actual revenues through to the bottom line. So that's how that works. And then our model is, as I've outlined, we go to events. We do a lot of I hate all these modern phrases, but thought leadership. We have a lot of white papers around this for organizations to look at. And then we do a lot of digital campaigns. We have an internal sales team working on lead generation every day. So it's the usual stuff, but it's proving very effective for us at the moment.
That's fantastic. Thank you very much indeed. You've addressed all those questions from investors. And of course, if any further questions do come through, we will be able to review those and we'll publish your answers back on the Investor Meet Company platform. Maurice, perhaps I could just ask you just to wrap up a few final words just before I redirect investors to give you some feedback, please.
Yeah, well, first of all, again, thank you for coming on the call and for showing an interest in Glantus. We've worked hard as a team. All of that team you saw there were all shareholders in the business. We've worked very hard to get this far, and even though the likes of Beach Point is expensive debt, it was meant that pre the IPO we still controlled 85% of the business, and post the IPO we controlled 55%. And the only thing I'll add to it is just those 3 points again. It's to say it's a proven technology, really sticky recurring revenues, and investors are completely aligned with management. It's nice to think that we will be this great AP company, and we have tremendous faith in that, but we are driven by the multiples and the arbitrage and how much we can grow the value for ourselves and our investors. We are very focused on that.
That's fantastic. Maurice, thank you very much indeed. Maurice Granier, Jeff, thank you again for updating investors today. Could I please ask investors not to close this session, as you'll be automatically redirected for the opportunity to provide your feedback in order that the management can better understand your views and expectations. This will just take a few moments and to complete, and this will be greatly appreciated by the management team and greatly valued. On behalf of the management team of Glantus Holdings PLC, we'd like to thank you for attending today's presentation. That now concludes today's session. Thank you and good afternoon.
Thank you.